So Plug Power stock is now officially down over 40% just in the past month, as higher interest rates have spooked many investors out of growth stocks. But apart from a spicy article highlighting the insane compensation that Plug CEO received in 2021, there really isn't any material news that's come out over the past few weeks to warrant such a big decline in the stock price. Until last night, that is. So in this video, I'll go over both the good and the bad from Plug's latest earnings report, share some of the upcoming catalysts for this company, and at the end, I'll analyze the stock chart to see where we could finally see a bottom in the big knife that Plug stock has had. But before we get into it, guys, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. As you can see, yesterday Plug reported its first quarter earnings results, and it's safe to say that most of Wall Street had expected a whole lot more from this leader in green hydrogen. As you can see, they ended up missing EPS by around 11 cents a share, while they missed revenue estimates by around $4 million. Now, although the revenue miss could be attributed to a lot of different factors, primarily in the form of inflation of goods and cost of goods, the EPS, on the other hand, is a little bit more of a disappointment, and it seems like Plug is blaming that on higher natural gas prices as a result of the Ukraine-Russian situation. But I'm sure the question you guys are asking is, why does higher natural gas prices affect Plug's business if they're developing and selling green hydrogen solutions? Well, the simple answer to that question is that green hydrogen is a business unit that Plug has not fully integrated into its business operations just yet, and a lot of the hydrogen that it transports over to customers is still made using natural gas, and that kind of hydrogen is called gray and blue hydrogen. And as you can see, although green hydrogen capital costs are expected to be cut almost in half by 2030, right now blue hydrogen is a little bit more economical, which is essentially the hydrogen where you combust natural gas to make that hydrogen, and then you suppress and capture all the carbon emissions that are released. And so although a lot of Plug's customers like Amazon and Walmart do want to reduce their carbon emissions, since the cost of green hydrogen is so high right now, these customers are only going to buy blue hydrogen. However, if you flip the coin and look at the other side of the argument, this massive volatility we're seeing in natural gas prices is very bullish for Plug's other business, which is obviously electrolyzers. And electrolyzers are the key component when it comes to making green hydrogen. And so down the road, as the demand for hydrogen fuel increases in both the industrial and the transportation sectors, there is going to be a massive demand for more price predictability and less dependence on foreign exports. And that right there is going to give a big advantage to the first movers in the green hydrogen industry. And since Plug Power is the only company in the US right now that is building a full-scale gigafactory that is simply dedicated to developing and manufacturing electrolyzers, there's going to be a massive tailwind for this business over the next couple of years. And the Russia-Ukraine situation is only shedding light on the underlying problem for which Plug Power has a big solution. But anyways, if we now move on over to the shareholder letter to get an idea for what Plug expects over the next few quarters, as you can see in the first quarter, their revenue grew by an astounding 96%, which is very impressive for a company that already does around $500 million in revenue. And since Plug stock trades at a price to sales ratio of around 21, this means that in terms of a forward outlook for 2022, this price to sales ratio could be cut in half to almost $10. And that is a very attractive valuation for a stock that is the undoubted leader in the green hydrogen and material handling fuel cell space. However, also to note is the fact that around 30% of all their 2022 revenue is going to come within the first half of the year. So what this means is that the growth rate of around 96% could potentially be the peak for all their quarterly reports this year, and that maybe for the third and the fourth quarter, their growth rates could fall to anywhere between 60 to 80%. But I'm sure that analysts have already priced that in, and their shareholder letter only confirms that theory. And probably the biggest argument that a lot of bears have put forward against Plug Power is also something that this company is significantly improving on, which is their gross margins on their fuel cell business. Now, although these are not capex margins and they are only service margins, this is still a right step in the right direction, because as the cost of goods starts coming down over the next few years, as inflationary pressures kind of subside, we should start seeing margins for Plug Power's fuel cell business really start to show their strength. And obviously the reason why their margins are going to be relatively strong as compared to the competition is because they're going to have pricing power due to their first mover advantage in the fuel cell and potentially even in the electrolyzer business. And by 2025, they have set out a goal to achieve 30% gross margin and around a 17% operating margin. And so theoretically, that could give Plug around $500 million in net income in 2025, which obviously would result in a forward PE of around $19 based on the market cap today. Now, obviously, forward PEs are calculated based on the following year, but even if you extrapolate that out, we could be sitting at a forward PE of Plug Power at around potentially 40 to 50. But obviously, that's not going to be any easy task, and there's going to be three main things that Plug is going to have to focus on in terms of their margin improvements. And that includes their actual equipment margins, which are their electrolyzers and their fuel cell modules, their maintenance and service margins, which is the cost associated with maintaining the equipment that these guys sell to their customers like Amazon and Walmart, and obviously their fuel margins, which is where they're going to be selling either blue hydrogen or green hydrogen to these customers, liquefying it and storing it in specific locations. And really the only two things that are going to allow Plug Power to reach those margin goals are going to be their economies of scale by expanding into acquisitions and partnerships, and their liquidity and balance sheet position, which is exactly what we're going to talk about next. As you can see, unlike a lot of other businesses in the hydrogen clean technology space, Plug Power actually has a very big benefit when it comes to their liquidity position they have and the limited amount of debt they have at this stage. Plug's total assets are now sitting at around 5.8 billion, with pure cash sitting at around 2.5. So Plug can pay off all their debt with their current cash position and still have around $1.5 billion left to invest in their own business. And because of this, Plug Power stock from a business execution standpoint is significantly de-risked as compared to a lot of other companies in this space. But anyways, to wrap things up, if we now look at Plug Power stock chart, as you can see, it's clearly been a very painful past month or so, as both the Nasdaq and the S&P 500 have been crashing with no end in sight. And obviously, if those big indices are crashing, then growth stocks like Plug Power are also going to get destroyed. But the good thing is that this kind of pain has been experienced by the stock in the past. And as you can see, with the RSI sitting around 30, we are entering into what we historically have seen to be a great buying opportunity. And as you can see, we have already seen RSI levels like these in the past in May of 2021 and at the end of January of 2022. And even if you go pre-pandemic, we have seen these kinds of oversold situations in Plug Power stock very much. We obviously saw it happen in March of 2020, but we also saw it happen throughout 2019, which is when Plug's revenue really started to accelerate massively. And even at the end of 2018, which is when we saw the bear market in the S&P 500, we did see that be a great buy the dip opportunity. And the good thing is that on the weekly time frame, we are now going to test this 200-week moving average, which is sitting right at that $15 level, which means that this should historically act as a very strong support region. And what's even crazier is that if you zoom out to the monthly time frame, we are also coinciding with the 50-month moving average right above the 200-month moving average. So if we break below this $13 level on some sort of collapse, then we could potentially start seeing a move down to this $11 and potentially even $8 level. But obviously, given Plug's amazing cash position and their balance sheet, that kind of move to the downside might be a little bit too much over-exaggerated. However, to really recover from this massive mayhem we've seen over the past 2 months, I think Plug Power will definitely need to recover above this $24 level. And above 24, we need to get above this $30 resistance level that we've had a very hard time breaking for the past 6 months. But anyways, guys, make sure to drop me a thumbs up if you found some value from this video. Let me know down in the comment section below your guys' thoughts on Plug Power stock and how many shares do you own. But anyways, guys, hope you enjoyed this video, and I'll catch you guys in the next one. Take care.